We are about to start our last housing market town hall for 2022. So today I do have a guest, Sean Crowley. I've been working with him for a few years now, and he's one of the best loan officers on the market. I'm really honored that he's going to be here to share with us how to create a win-win negotiation strategy in a slow market. I think it is really important right now, especially a lot of buyers and sellers feel very helpless, because they're not sure how to move the property. But I think there are actually quite a few different strategies that we can implement to encourage buyers and also help sellers to move those properties. So we're going to get into it in a little bit. First, let's start with some updated news with our YouTube channel. If you follow us on our YouTube channel, you'll notice that we have been adding a lot more different type of videos on there. So I hope that you will subscribe so you can get notification whenever we have a new videos. All right, so I want to share with you, Sean, and see what you think and if this makes sense or not. So obviously, you can tell everybody in terms of 30 years mortgage rate, it really relying on kind of like looking at the 10 years yield, right? And the yield has peaked at around October at 4.2, and now it came back down to about 3.5, because like we have heard from quite a few different loan officers, the interest rate has been coming down a little bit. Can you tell us a little bit more about that?
Yeah, I mean, so the Fed fund rates, which is what they have control over, those are short-term interest rates.
Mm-hmm.
And right now we're dealing with an inverted yield curve, meaning that the 10-year treasury yield is around 3.5. The 5-year treasury yield today is at about 3.65. The 1-year treasury yield is actually at 4.75. So you could actually lock up your money for 1 year and get a guaranteed 4.75% right now. So that means that short-term people think rates are going to be higher. Mm-hmm. But longer term, the market is pricing in lower interest rates in the future. So nobody wants to guarantee a 4.75% return for the next 10 years because they just don't feel like that's likely to happen. So, what people sometimes realize is the news is the Fed raised rates 0.5% today. But as you mentioned earlier on the call, that was in line with expectations or maybe even slightly better than expectations. So after the comments came out, and I think that they were expecting a pricing increase, mm-hmm. But they were more focused on what were the comments. And the comments were that what we're doing is working, and we were doing this intentionally to tame inflation. And so the market really had no reaction day. So the market closed at 3.5% on the 10-year treasury, which is most correlated with the 30-year fix. And the day before it was maybe 3.49. So we're talking minimal movement based on the news that came out today, because anytime you meet estimates, it's just like a stock. If the stock hits its income estimates, it's great. If it exceeds them, the stock goes up. If it misses them, the stock goes down. So it's kind of the same thing going on right now.
Yeah, it's interesting because I kept talking about we are being induced, like this recession is being induced by the government, and they don't like to see such great employment. They want more people to be unemployed right now. So we're artificially really trying to slam the brake on the economy just so that we can get a better inflation rate. So yeah, it's really interesting to see how our economy is being driven by these government making decision on the Fed funds rate for us. But then at the same time, I still have so much confidence in our economy just because of the fact that we know this is artificially being pushed down right now.
Yeah, and it's also kind of fascinating that while we know we've weakened our dollar, I mean, we can all see the cost of milk and eggs and everything else that's going up, even, gas. But on the flip side, when you compare the strength of our dollar to other economies, we're still seen to be outmaneuvering this pandemic better than most.
Exactly. All right, so this one I thought is interesting too, and maybe, I don't know if you have any insight about this. So when we look at the spread between the yield and the mortgage rate, it looks like the averages would be about 1.79. But right now, if we look at this, so the mortgage rate we have currently is actually about 2.99 spread over the Fed funds rate. So do you see why the reason that there is like a bigger spread in comparison to our average spread?
I mean, I'm not an economist, but my gut tells me, what we're seeing here, and this kind of explains a lot of what we are seeing, is the Fannie Mae rates right now are much, much higher than the portfolio loan products. Okay. So the banks are able to borrow, at a certain rate, and then they charge a spread because they have to pay their people, to make a profit, to stay in business, all that stuff. And that would probably correlate to this 1.79 number. But what's happening is most of America has to get a Fannie Mae loan. I mean, Fannie Mae covers loans up to about $970,000, and in most of America, you can buy a pretty nice house, for under $600,000. So, we're in a kind of a separate area here in the Bay Area where we have access to jumbo loans, and that's why the jumbo rates are actually lower than the Fannie Mae rates. Fannie Mae is government backed, and the government wants to slow down the economy, so they can kind of control what Fannie Mae is allowed to offer as far as rates go. And so I don't think that it's an intentional spread because people want to make extra money. I think this is because the government has their foot, or they're encouraging, or I don't know what they do behind the scenes, but Fannie Mae's rates are much higher than everyone else's, and there's a reason for it, and it's because the government's involved.
I mean, I'm so glad you said it, and you said it way better, obviously, compared to what I would have said. And I felt like that is really the reason why. And this is also why I think the next graph, next chart right here is going to show that the mortgage rate is going to start to come down soon, because like once the government, like you said, right, the government's starting to see like, okay, the inflation is slowing down, we are in the right direction, the spread is going to come down a little bit, and hence our mortgage rate is probably going to come down as well. So every month we track these projections by Freddie Mac, Fannie Mae, Mortgage Bankers Association, and National Association of Realtors. And actually, last episode I did talk about like, gosh, last time when I looked at their numbers, they were 140 basis point lower. So their projection was at 5.2, and I was just like, wow, how come the projection is so low? And they now have adjusted all of their projections. Now is at 6.6 for 2023 1Q, 2023 2Q at 6.5, and then 3Q at 6.4, and 4Q at 6.2. And Fannie Mae is a little bit more, I guess, like conservative or aggressive. Is actually 1Q, and they are expecting to be at 7%. I guess like probably the conforming loans they're going to look at is it looks like it can hit 7% by January though. And 2Q is going to be 6.9, but after that 3Q and 4Q is going to come down slightly, just like what Freddie Mac is projecting. And same thing for Mortgage Bankers Association, but their numbers a little bit lower at 6.2 for 1Q, 5.6 for 2Q, 5.4 for 3Q, and 5.2 for 4Q of 2023. And then lastly is National Association of Realtors. They've been having this projection at about 6 since October at 6.5 for 1Q, 2Q at 6.4. Same thing after 3Q. They expect the number is going to come down as well. So do you think that you're going to start seeing more, maybe at that time we'll start seeing more activities like maybe second half of 2023?
I mean, I think we're already seeing it. And I think these numbers are average interest rates, which take into account all different types of credit scores. But for like an A borrower right now, I mean, with even 5% down, I'm seeing Fannie Mae rates at around 6% already. So it's already happening. And, again, this was in October when we kind of peaked. And you've already seen the 10-year treasury yield. It peaked at, what was it?
It's like October.
Yeah, October, it peaked at 4.2, and today it closed at 3.5. So we're already down 0.7% from when those forecasts came out.
Yeah. So I mean, it's like I'm excited to start seeing numbers coming down, because like all these projections previously is all like going up, going up, going up. But now it's like actually starting to say like, okay, it might come down, and well, most importantly is the inflation rate, right? We started seeing that to come down as well. So today I'm really truly appreciate you coming on and to talk about how to create a win-win strategy, because as you saw earlier, some of our numbers is like the sellers want to sell and it's been staying on the market for a long time. And so even though they get a lot of offers, people are offering way below, a lot of lowball offers. It's crazy. So we talked we talked yesterday a little bit about how to create win-win strategy. One of the most popular program out there is.
It's the 2-1 buy down right now. So that is getting a lot of attention. It's been around a long time, but for the last 10 years or so, nobody's really thought about it. And now that we're back in a rising interest rate environment, especially one where we believe that rates will only be like this for the short term, not the long term. And it's not just us as people in the real estate profession trying to sell people on why they should buy now. I mean, that's why there's an inverted yield curve. The inverted yield curve is all of Wall Street telling us that rates will be lower in the future, because the people that buy 10-year treasuries and stuff like that, they're much more sophisticated investors than we are. And they're kind of building out their models, and it's all about supply and demand. So
can you give an example of how would a realtor work with you to get that executed?
Yeah, I mean, I actually have if I can share a quick spreadsheet. It really kind of breaks it down and kind of simplifies how it works and why it works.
Absolutely.
So, I mean, a lot of clients right now, because rates shot up so quickly, they are afraid. That's their monthly payment. So we have people that were pre-approved back in December of last year. They didn't pull the trigger for one reason or another. And then they come back 6 months later and their rate's 0.5% higher. And that's really increased their monthly payments. And it's creating a lot of, what they call payment shock. And so a lot of borrowers are retreating from, their original plans because their payment has gone up. Now, as I was mentioning earlier, Wall Street's already telling us that it's going to get better. We don't know exactly when, but it is coming. And so what we have here is a program where, as the seller, you can help the buyer get more comfortable with their payment, and they have a 1 year buy down. So you buy down by 1%. They have a 2-1 buy down, which allows you to, drop the rate by 2%. So in the first year, and this is why, if you didn't do the 2-1 buy down, their monthly payment on, say, a $1.6 million purchase with 20% down, their mortgage payment would be $7,068. You guys can see this, right?
Yeah, now that you're enlarging it, much better.
Okay, cool. So that would, but in the first year, if you do a 2% buy down, their monthly payment's going to drop to $5,570. So reducing people's monthly payment is just going to help them get more comfortable. I mean, there's generally certain things that just happen in life, especially for first-time home buyers. Generally, their income potential is going to grow over time. They're going to get more. There's a lot of expenses when you first move into a house, just getting situated, buying furniture, painting, moving costs, like just everything that in the beginning. So they should be able to shore up more savings over the next couple of years. So this just helps people kind of get comfortable, and with the opportunity to refinance. Then the second year, it goes up another 1%. So their payment increases by another, say, $700. But again, it's helping them kind of stave off this high rate, high payment. And it's really simple. All you do is you say, okay, here's the difference in the monthly payment. So you, as the seller, if you wanted to entice people to buy your property, you would just cover the difference in the monthly payment. Okay. So the difference in the monthly payment in the first year for 12 months is $18,000, and the second year, it's about $9,000. So you'd be offering a $27,000 credit towards the closing costs to help them get in. It comes out to about 2% of the loan amount, a little bit less than 2% of the purchase price, because we're only doing 80% of and it's just, it's a way to get more buyers in. Buyers like it because it helps them with their payment. And, this helps kind of simplify the math, so people kind of see, like, hey, how does it work from a seller's perspective? Yeah. And from a buyer's perspective, it's just helping you save money. And the best part about it is, if you refinance 6 months from now, because we already just saw the forecast. If rates drop 0.5%, you should probably refi. So if rates drop 0.5% and you can refi, say, into 4.75 at no cost, you should definitely do that. And any money that's left over will go towards a principal reduction.
I mean, this is really exciting that a lot of people don't know. And then in terms of, like, from as a realtor, right, listing agent and representing the seller, we were like, this is way better than doing a price reduction, because easily, if you do a price reduction, it will be with 50,000 minimum to do a price reduction to have even any kind of significant. I don't even think 50,000 for $1.6 million would make a big difference in terms of gaining the interest. But if you say, like, we can get you in for 3.25% on the first year mortgage, that is very enticing. And you only
Yes.
need to have out of pocket of $27,000.
Correct, correct. I mean, there's a lot of tactics we've always had at our fingertips that people just don't think about. I mean, the other one is if you have a buyer, because this is the other thing that's happening, certain buyers based on their income,
Hmm.
they may be at their max purchasing power.
Sure.
And this is a strategy where you're spending about $27,000. I was looking at another idea, and this has been around forever, but it's not new, but it's more impactful now. If someone's kind of at their max budget, just the difference in paying 1 point, if the seller pays 1 point to buy down their rate, which is only 0.3%, so 2 points would even give more buying power. Here's an example where this buyer, if they're
Oh, sorry,
maxed
can
out.
you
Oh, yeah, I'll
enlarge?
zoom in again. There you go. So 20% down, 10-year arm. If the seller covers 1 1/8 points, they just increase the buyer's buying power, because look, it's the payments the same by $55,000, cost them 14, so they're going to net about an extra $40,000 by just paying some points to help the buyer, qualify for more.
That that is huge. That's huge. I mean, I think this is something that I do know, like a lot of popular realtors who have been around for more than 10 years. I had experienced the last recession. They know how to work on this, but there are a lot of newer realtors. You can absolutely talk to your lenders to see how you can help your buyers or sellers to get into the market because like the interest rate, we always say that buys actually, if they're living in a house long term, they're really buying the monthly payment, right? They want the
Yep.
monthly payment that they feel most comfortable at, because the price long term wise it should be going up. And if the interest rate comes down, you can always refinance. So I'm really excited about this. I think this is like one of the much better option to offer seller, and then even sellers like, really, we can do that. They don't know this is an option, and you can save them so much more money compared to doing price reduction.
Correct. Correct. Yeah. No, I mean, there's a lot of different strategies. There's some old, just tax advantage strategies for sellers, being able to kind of choose when they close, things like that.
Mhm.
And then we also have some programs, that just help first time home buyers who are either in a certain income spectrum. I don't know if you wanted to touch on those at all.
Yeah, absolutely. I think that would be
Okay.
important to know, because obviously, like for example, purchase price of 1.6, that's kind of like more in the Santa Clara County. But then if you're in Alameda County or Contra Costa County, as we saw, is different price point. Absolutely. We should definitely look into a different price point as well.
Yeah. So, I mean, for homes that are if you're a first time home buyer, so you haven't owned a house in more than 3 years. So yeah, I think that's a caveat that people need to understand. First time home buyer just means you have not owned a property in 3 years. And you are buying in a lower moderate income area, regardless of your income. There's a program called the Union Bank Grant that allows you to have between $9,000 and $12,000 gift towards your down payment. And the reason why this is pretty cool is in certain markets, like you just mentioned, Alameda and Contra Costa, there are homes out there for 600,000. So, if you were planning on putting 5% down, now instead of saying having to put 30,000 down, it's going to be 21 to 18,000, and you can buy a home. And given the market we're in right now, sellers might be willing to give a credit towards closing costs. So it's going to bring more borrowers to the table, because now it's less about, if you can buy a $600,000 house with just, $18,000 to $21,000 and have all your closing costs covered by the seller, that's a big deal. And that's going to allow people that maybe in the past were having trouble saving up the down payment to get in while values are depressed, and
Mhm.
they're going to build equity over time as the market recovers. And in the reason why it's 9 or 12 is in Alameda and Contra Costa, it's $12,000, as well as a couple counties in Southern California. So
Oh,
that's kind of a cool program. There's another one called Neighborhood Lift, which we can provide in an email, but it's about a $25,000 grant towards down payment. That's a little bit of a lottery system, but it kind of explains that. And another thing that's pretty cool is, my company just got acquired by US Bank, and US Bank actually announced as part of the merger 100 billion in community benefits. So they're going to be rolling out programs, and this is in coordination with the National Community Reinvestment Coalition and the California Reinvestment Coalition, and it's going to be to help focus on low and moderate income communities to do even more for those. So kind of a big deal. A lot of free money out there to help first-time home buyers get into programs. So I mean, when people are looking for those kind of opportunities too, I think they should take advantage of them.
Can you maybe expand on, I don't know if it goes into too much of a detail on those grants? One is the qualification, how do they qualify for it, and how complicated the process might be?
I mean, the neighborhood lift's a little bit different because there's a lottery system, but for our program, it's pretty straightforward. You have to use one of our loans. You have to be a first-time home buyer, which I mentioned is, haven't owned a home in the last 3 years. It must be your primary residence. This cannot be for an investment property. You have to take a class, but the class is a 1-hour online class, and people actually tell me how much they really enjoyed it and they wish they had taken it before they got in a contract because they learned so much. And then there's 2 ways to qualify, either based on the location of the property, low or moderate, or if you're underneath the 80% AMI threshold, average median income threshold.
Now, in terms of, like you said, like the property must be intended to be owner occupied as the applicant's primary residence. Is there a time period in terms of like how many years it has to be the primary residence? I
mean, the typical, is 12 months. We understand that sometimes life happens and things get in the way. It's not like there's someone who's going to be knocking on your door on your 13th month to make sure you're still living there or anything like that. But the point is it's, if somebody lives, I mean, sometimes it's obvious if it's an investment property, right? And so the story has to make sense. It has to be your primary residence, as long as the underwriter's not going to question it, you don't own any other property, and you can still get to work, or your company allows you to work remotely, then there's no reason to question it.
Yeah, and I guess one of the reasons I bring this up is that obviously there are a lot of different grant programs out there, and if the audience or whoever is applying for a grant, make sure you really pay attention to some of these restrictions. And for example, as I mentioned, if it's intended to be owner occupied, sometimes some of the grant program that actually would specifically say for the next 5 years, you cannot have the property rented out for the next 5 years. So make sure to pay attention to some of these verbiage and understand the requirements.
Yeah, I mean, ours basically has no strings attached. It's just free money, and it actually can be used towards down payment. So it's not a loan. A day later you could do whatever you want with the property. But yeah, so it's truly helping people get into homes with no strings attached. But yes, you're right. A lot of the other programs, I know, like in San Francisco, if you use some of the mayor's office of housing money, they won't support anything that would result in evicting a tenant, right? Because they're trying to grow, they're trying to create more housing and not, so if there's a tenant occupied situation, they won't be involved, for example.
Yeah, and some of the grant programs I've seen, sometimes they might have this profit or equity sharing element.
Yep. Correct. Yeah. So again, this one, no forgiveness period, but yes, there are some with a forgiveness period, like over 5 years, they forgive 20% each year. Some, it's just they have a percent ownership in your home. So look, I mean, this one's free money. Some of the other programs, you definitely have to think about, like, do I really want to give up a piece of my equity? Is it worth it to me? If you can make it, generally speaking, if you can make it work without some of the down payment assistance programs, it's better, because then you're in complete control of your investment and you get 100% of the upside. But for other people, it's the only way they're ever going to get into this expensive market. So they should take advantage of every program available to them.
Exactly. So, I mean, that's why it really depends on the loan officers you work with. Make sure you ask these questions. Hey, what are the requirements, restrictions, the time frame, and also if they actually have will take in any part of the equity of the property. That's the big one, because as you know, this market, if you have gained that much equity, and sometimes we saw right during the last peak, some of the home equity had doubled, and you have to give up a certain percentage. That hurt. That can hurt quite a bit. So besides some of these Union Bank offered grant programs, is there anything else that you would recommend? I know we talked about we can even look into seller financing.
Correct. Yeah. So We allow seller financing, and a real big advantage to seller financing. I mean, right now with sellers having to take a hit on what they believe the value of their home is. Okay. Really for them, if there's ways for them to maybe avoid paying taxes on certain things, like right now, if they were to get in a contract, most likely that property is going to close in January. So the good news about that is technically they don't have to file their gain on that with their tax returns until April 15th of 2024. So there's a little bit of time delay on that. So that's just kind of one minor thing. But the other thing with, what seller financing allows you to do is, and again, I'm not a CPA, so you definitely should consult a CPA, but if you sell your house for 1.6 and maybe the borrower does half the loan through their lender, and then they do another half of the loan through the seller doesn't have to pay gains on the portion of the loan until the loan gets repaid. So it's a way to kind of delay capital gain events or taxable events over time. And so for certain folks, that could definitely create some great tax strategies. The other option is if you are willing to, be flexible on your close of escrow date, and the seller wanted to get involved into some kind of 1031 exchange or something so that they didn't have to pay taxes, that would be an advantage to them, because a lot of times they have to identify their next property within a certain amount of time. And so by allowing being flexible on when you close, that's another way to be, to get an offer accepted that maybe wouldn't normally get accepted. So
Yeah.
It's just trying to figure out but you really have to know what is it your seller needs or wants. And so by if the seller's going to sell for less than what they wanted, giving them some favorable tax treatment could make all the difference in the world.
Yeah, exactly. That's like a great point, because like the seller's really hurting by selling it cheaper, but at the same time, you can bring that up, right? The saving tax portion for them, and they didn't feel like, oh, okay, and they can become the lender, kind of earning on the interest on the loan that they are selling back to you. So that's another way for them to kind of make back the money. But then it's going to be a little scary for a lot of sellers. It's like, I don't want to be a lender. So it really requires a realtor to really explain, and of course the loan officer to explain how does that work. And in terms of like, you have to create like a promissory note that needs
Correct.
to be recorded at the recorder's office. So it's not something that you just do it behind the scene on a piece of paper. These documents actually will be recorded, and therefore Union Bank, for example, will know that there is a second lien on the property. The lien holder is the seller.
So the way it works is like Union Bank would be in first position. So what that means is they just get paid back first if there was a default or something. But it also makes what they call the second the seller financing, they call it the fulcrum security, meaning if the borrower doesn't perform, they kind of get back in the driver's seat. They're now in control, and they can actually take back the property. Okay. Now, obviously there'd be some legal stuff involved with all that, but if they stop paying on the first loan and stop paying on the second, that would put them in control of repossessing the property. So there is I know there's some upside with the interest rate, but they could actually, if the buyer did not perform, they would actually be able to take back the property and sell it again in a few years. So again, messy, but there is additional upside involved there as a lien holder.
Can you also explain a little bit about, so in terms of the debt to income ratio, right? If there's a seller financing, is that going to still count into it? So, I mean, at the end of the day, it's really the borrower still has to be qualified, because there is now another loan on the property.
Yeah, because we're recording both loans at the exact same time, we're going to be factoring in, the monthly payments with the second lien loan as well.
So if the second lien is interest only versus fully amortized, so that would be a little bit of an advantage in terms of the debt to income ratio calculation.
It wouldn't actually. So normally the reason why you see seller financing as interest only is it's just much easier to figure out the math. Right? Like to do amortization and do all that, it gets these really complicated formulas that you have to factor in. If the buyer wants to make an extra payment towards the second loan, then it kind of throws off all the calculations. So usually what people say is, hey, here's the interest only calculation, because you just take the interest divided by 12 on whatever the remaining balance is. And that way, if they want to make an extra payment, they can. You just reduce the balance. That'll reduce their future payments on the interest side. So that's why you see a lot of seller financing as interest. But when we qualify the borrower, we're still going to use an amortizing payment for that piece. So we're still going to qualify them like we would a traditional loan. So it doesn't help with helping them qualify for more. But again, it's a way for the seller to not realize all the capital gains on the day they sell, and it allows them to defer some of that, and it allows them to make income in the meantime. So for certain sellers, especially if they're retiring or downsizing their home and retiring, they kind of like the idea of having an extra stream of income, especially at the rates where we are today, right? You say, hey, I'm going to pay you 6% or something. They're like, that's a pretty good return on my cash. I like that.
Yeah, absolutely. I agree. So that will be something. Actually, I had proposed this to one of my clients, sellers as well, and they actually really like this idea. But again, some of the clients may not understand how it works. So just be sure to work with your loan officer and explain the process. And these are some of the options that you can share with the buyers, or buyers share with the sellers. It doesn't really matter from which side, is from the seller side or from the buyer side, but it's just matter that there are these programs that you can entice seller to accept your offer, or to entice buyer to make offers on your property. So there are different ways besides just reducing your offer price. So is there anything else that you would recommend? Anything else that we should know?
I mean, let's see. I mean, going non-contingent, just some of the old basic stuff, like not going non-contingent, closing fast. It just, again, you need to understand what your borrower, or free rent back, flexibility on closing. Like, you just really kind of got to work with your seller. So the more adaptable you are to work with the seller, the more likely you are to kind of get your offer into contract right now.
Yeah, and of course the market has changed quite a bit. So we do see, like we mentioned earlier, a lot of buyers are coming in with contingencies. So there are times for you to really do your inspections, and also the loan, maybe really figure out what is the perfect loan program. Really have to, I think at this time, you really have to work with your loan officer even more carefully compared to before. Don't use your pre-approval letter from 3 months ago. A lot have changed in just 3 months. So be sure, before you make an offer, ask your loan officer to run the numbers again before you submit that offer.
Yeah, well, I can tell you, when someone asks for a pre-approval letter, we are rerunning all the numbers right now, just because so much has changed just in the last couple of months.
Exactly. Well, thank you so much, Sean, for being here and answering some of these questions. I think those are really, really cool strategies, especially the 2-1 program and the seller financing, and of course these grants that are available for buyers to consider. So really appreciate you coming up, and I hope to see you again soon.
Yeah, happy holidays, everyone, and please just don't hesitate to reach out if you have any questions about any of the stuff we discussed. I'd be happy to help you.
Sounds good. Well, thank you everyone for joining, and happy holidays. I guess we'll see you guys next year then. Bye.